Well, the markets are gearing up for the Fed's April policy meeting happening right now. Investors will be watching the Fed's statement released Wednesday at 2 p.m. for any clues on when the central bank might hike short-term interest rates. Here with more analysis is Ian Weiner, head of equity trading at Wedbush Securities, joining us now from Los Angeles. And Ian, what should investors be looking for in this week's FOMC meeting?
Well, I think the key thing investors need to look for is the language coming out of the meeting. I think at this point there's almost no expectation for a rate hike in June. I think that's been pushed to September. And I think it's going to be interesting to see how they talk about what's clearly been a slowing global economy, some weakness in the U.S. as of late, and the dollar strength. And so I think how they discuss that and sort of how that impacts their decisions going forward, I think is going to be more of the key. And we'll see if people feel like a September rate hike is now being pushed out after this meeting, then you probably get more fuel for the rally.
All right, but for investors, is this unnecessary anxiety at this point, monitoring, the day-to-day operations of the Fed, which is what it seems like investors have been doing for quite some time now?
Yes, I think it is certainly not something that, I as an investor put a lot of focus on right now. The global liquidity continues to increase, and either you believe the second derivative is going to continue to increase or it's not. And if you believe it's going to continue to increase, then whether the Fed raises 25 basis points in July or June or September, I don't think is really going to impact things too much one way or another.
Perhaps the second or third rate hike is more important.
Sure, as things go up, but there's no indication that they're going to be raising rates quickly anytime soon. And the economic data, which they've said they're data dependent, certainly hasn't justified a move, and there's no inflation anywhere. So there are two big things that they're looking at. Unemployment, yes, is down, but you could certainly argue that that's more a part of the workforce than it is anything else as far as participation rate. And no inflation. So those are your two data points that they follow, and they certainly aren't pushing for a Fed rate hike anytime soon, and certainly not anything aggressive.
All right, let's talk about the markets. We're seeing the Dow, the S&P 500, and the NASDAQ flirting with record highs. Is there risk of a correction on the horizon in your view?
Yeah, I definitely think there's risk of a correction. Look, at the end of the day, the leadership of this market is what matters, and the biotech is key. Now, they've had a nice bounce off the lows today, but they had a big drawdown yesterday, and I think that that's important to watch. I also think the action in Apple is important to watch to see what that stock can do. Both are relatively crowded longs, and we'll see how investors are positioned based on how those stocks trade. But I think the risk is that, look, at some point people are going to wake up, and maybe tomorrow, maybe a week from now, that if S&P earnings for 2015 are very likely going to be below 2014, and so you're basically buying the market here for continued multiple expansion, because again, there's no alternative according to the bulls. So, in my opinion, yeah, I'd be pretty cautious here.
All right, Ian Weiner, thanks for joining us.
No problem.
I'm Scott Gamm, and you're watching The Street.